Hi, I'm Chris Camburn, the creator of AnnuityNest. Annuities can be smart investments to help with your retirement planning. However, they can also be confusing, misunderstood, and misrepresented. My goal with AnnuityNest is to help you learn about and understand these products so you can determine if one might be helpful for you. In this video, I review my free guide to annuities, which you can download through the link below, and read along with this video. You can also browse my site and request a quote or call for personalized assistance. Something to know in advance is that as a licensed and regulated financial advisor, it's not permissible to provide any details on specific annuity contracts within this video, or simply claim to know the best annuity ever when we haven't had a chance to address your particular circumstances. If you'd like personalized guidance, we'll work with you to gather, evaluate, and analyze as much information as necessary to find an appropriate annuity for your circumstances. Simply contact us at any point. Now let's get started. An annuity is a contract between you and an insurance company in which the insurance company promises to make periodic payments to you starting immediately or at some future time. You buy an annuity either with a single payment or a series of payments called premiums. There are some features of all annuities that are helpful to know, and then there are differences between category and type of annuity that can help you decide which to consider. In general, all annuities, regardless of category or type, are long-term investment vehicles designed for retirement purposes, and guarantees are based on the claims-paying ability of the issuing company. If you use an annuity as a savings vehicle for future payments, you have a deferred annuity. And if you use the annuity to create a source of retirement income, and your payments start right away, you have an immediate annuity. Each annuity has an owner, an annuitant, and a beneficiary. The owner is the person who purchases the policy, the annuitant is whose life the policy benefits are based on, and the beneficiary is the person who would receive any remainder monies should the annuitant pass away. It is common for the owner and annuitant to be the same person with a separate beneficiary or beneficiaries. You can invest IRA monies and or non-IRA monies into an annuity, and if you use IRA monies, you have what's called a qualified annuity. If you invest non-IRA monies into an annuity, you have what's called a non-qualified annuity. Within any annuity, any investment gains are deferred from taxes until you make a withdrawal, regardless of whether the gains are from interest payments, crediting methods, or investment performance. Unless you are annuitizing your contract, which I'll discuss later, all withdrawals are on a last-in, first-out method, which is regulated by the IRS. And what this means is that if there are any gains, you withdraw the gains first and then your principal. Hey everyone, Chris here in the editing room, going through the video today, and I thought at this point I hadn't had a slide prepared during the recording of this, but I thought maybe a slide that illustrates how this taxation of annuity withdrawals works might help. So I'm going to put up a slide and rewind a little bit to the beginning of that section and hopefully make this a little bit easier to understand. Based on these rules, all interest is taxable at your ordinary income rate at the time of withdrawal, and your principal is not taxable unless you're withdrawing it from an IRA annuity, because all withdrawals from IRAs are taxable unless the withdrawal is transferred into another IRA or another annuity. And all withdrawals made prior to age 59 and a half are subject to a 10% IRS penalty on any gains in a non-IRA annuity, or a 10% IRS penalty tax on any gains and principal if it's in an IRA annuity. Lastly, almost all annuities impose surrender charges. Surrender charges are typically based on the length of your contract and have higher charges in the early years with declining charges to the last year. Think of these as early termination fees or early termination penalties. Most annuities will permit you to withdraw up to 10% of your investment annually without surrender charges, and this is known as the penalty-free amount. There are some exceptions that will allow you to exceed this penalty-free amount, such as health-related issues and nursing home admittance. There are two categories of annuities: Fixed and variable. Within the fixed annuity category, there are three types of fixed annuities: fixed annuities, fixed indexed annuities, and immediate annuities. Within the variable annuity category, there are two types of variable annuities: variable annuities and structured annuities. Fixed annuities are considered insurance contracts, and variable annuities are considered investments with insured components. Annuities within the fixed category can offer standard benefits such as principal protection, stated interest, as well as variable interest and credits, various income options, and death benefits for beneficiaries. Optional riders that are available for an additional fee can provide for enhancements to some of the standard benefits. The main difference amongst fixed annuities is the calculation of interest, which we'll discuss in more detail within the guide. Annuities within the variable category can offer standard benefits such as the potential for growth, some protection of principal, and various income options and death benefit options for beneficiaries. Optional riders that are available for an additional fee can provide for enhancements to some of the standard benefits. As a generalization, you'll typically have a lower potential for investment growth and a lower risk of loss of principal in a fixed annuity, and you'll typically have higher potential for growth and a higher risk of loss of principal in a variable annuity. All of the potential outcomes have to be paired with each annuity's guarantees and costs to determine which one can work for you. When you make a withdrawal from a non-immediate annuity, your principal continues with your chosen investment strategy. However, when you annuitize a contract, you forfeit any principal to the insurance company in return for a series of payments, whether for a set number of years or for your entire life. And if you annuitize your annuity, the taxation works a little bit differently than if you just take withdrawals. Recall that when you take withdrawals, if there are any gains, you withdraw the gains first and then your principal. However, when you annuitize your contract, payments will include some portion of principal and some portion of interest. The amount of your payment that is return of principal will not be taxed unless you're withdrawing it from an IRA, and the insurance company can tell you what amount of your payment will be principal and what amount will be interest using a calculation called the exclusion ratio. Now you may wonder why anyone would annuitize their contract and forfeit their principal to the insurance company. This may be a desirable option if you need higher annual payments than relying on any fixed or variable rates of growth, and the majority of your initial payments in a non-qualified annuity will be non-taxable return of principal using that exclusion ratio. In a deferred annuity contract, enhancements called riders that you buy for additional fees can permit you to withdraw earnings first and then your principal, so you still have access to your remaining cash balance, and then annuitize the contract at a later date or if necessary. Some generalizations to know are that the longer your payments are guaranteed to last, the less they'll be on an annual basis, and generally the older you are, the higher the annual amount will be, and payments for one person's life are typically more than if you were receiving payments for two persons' lifetimes, as is often the case with contracts covering married persons and certain cash refund period certain options for your beneficiaries will also reduce your payments vis-a-vis the longer the cash refund period, the lower your payment. Riders are optional benefits offered with some annuities that you can buy for additional fees, or as in the case of fixed annuities, you can choose for reduced growth rates or reduced interest rates. These come in the form of living benefits, withdrawal benefits, death benefits, or return of premium. Currently, the most popular choice of riders provides increases to your contract's living benefit base, withdrawal benefit base, or death benefit base, regardless of investment performance or interest crediting methods. These riders may increase one or some of your benefit bases to the higher of your actual investment-based returns, or your original investment plus a guaranteed increased amount. These guaranteed increases can be calculated annually or prorated throughout the year and may last for a limited amount of time, such as for 10 years, or until a certain age. A living benefit base or withdrawal benefit base is not a cash value. Rather, it's used for the sake of calculating guaranteed annual payments. The annuity company will calculate your withdrawal amount from the greater of your benefit base or your actual account value and calculate your withdrawal amount from that value. Currently, living benefit and withdrawal benefit rates are in the range of 3 to 6%, depending upon your age when you purchase an annuity and your age when you begin withdrawals. Some of these riders can guarantee annualized payments or withdrawals for your entire lifetime, even if the cash value of the contract reduces to zero. This occurs when the interest rate, crediting method, or investment performance does not keep up with the amount of your withdrawal. If you average returns of 2% but withdraw 5%, at some point your contract will run out of money. Some riders offer spousal continuation, which means that if the beneficiary is the annuitant's spouse, they can continue the contract with the same benefits as if they were the original owner. And this is helpful when a couple is depending upon the annuity's income and their surviving spouse will be counting on that money. Lastly, some annuities offer inflation riders, meaning your initial payment can increase if the index for measuring inflation increases. However, your payment cannot decrease, even if there's a decrease in the inflation index. Death benefit bases are usually lump sum walkaway amounts for your beneficiaries, and standard benefits are usually your original investment less withdrawals. However, some riders can provide guaranteed annual increases to your death benefit as well. Return of premium riders can provide for a return of your original investment, either via lump sum or annual payments. For variable annuities, this return of premium feature is typically a guarantee of your original investment back at the end of a 10-year period if your account value has decreased in value. Some fixed annuities offer return of premium guarantee, which means you can receive all of your principal back at any time, but you usually have lower rates than comparable annuities without a return of premium feature. Now, I've outlined all of these similarities and differences in a grid within the guide, so if you haven't taken a moment yet to download the guide, please do so now, and you can see these in a more comprehensive grid format to understand. A fixed annuity is a contract between you and an insurance company where an insurance company provides you with guaranteed rates of interest on your investment for a certain amount of years. Fixed annuities are intended to provide you with capital preservation, income, or growth. There are no annual operating expenses or investment management fees with fixed annuities. However, there might be an annual account fee or contract fee of $50 or so if your contract falls below a certain amount, normally $50,000. Most fixed annuities have surrender charges and a penalty-free withdrawal amount, and some contracts offer a return of premium guarantee. This means you can receive all of your principal back at any time, but usually have lower rates than fixed annuities without a return of premium feature. Your investment safety is based on the claims paying ability of the issuing insurance company, and fixed annuities provide a set interest rate for an entire term of years, or a fixed rate for a few initial years, with renewal rates occurring on your contract anniversary, which can be higher or lower than your initial rate. Rates are typically higher the longer you invest, and typical terms are 1 to 10 years. Annuitization is an option with fixed annuities, and with fixed annuities your principal does not fluctuate and only increases based upon annual interest paid by the insurance company, or decreases based upon withdrawals by you, the contract owner. Riders are available on some fixed annuities. A fixed indexed annuity, also known as an equity indexed annuity or indexed annuity, is a contract between you and an insurance company where the insurance company provides you with either a fixed rate of interest or an annual credit, which is essentially the same as interest, to the account based upon the returns of a widely recognized investment index, like the S&P 500, Dow Jones Industrial Average, Russell 2000, or some international index based upon a predetermined formula. These choices are known as crediting methods, rates, or buckets. With fixed indexed annuities, the investment objective is to provide you with capital preservation, income, or growth. As far as fees and expenses, there are no annual operating fees or investment expenses for most contracts offered unless you choose an optional benefit known as a rider. However, there might be an annual contract fee of $50 or so. If your contract's below a certain amount, $50,000 is the normal threshold. Most fixed indexed annuities have surrender charges and a penalty-free withdrawal amount. Your investment safety is based upon the claims paying ability of the issuing insurance company. As far as potential guarantees, a popular feature of these annuities is that your investment will never go down in value in any bucket you choose because the stock market or index has a negative return. However, if the market index linked to your annuity goes down and you receive no or minimal index-linked return, you could lose money on your initial investment due to surrender charges or any fees that might be charged. Annuitization is an option with fixed indexed annuities, and as far as the fluctuation of your principal or return, with fixed indexed annuities you have the choice of fixed rates or indexed rates. Under the fixed rate choice, you will be provided the option of a guaranteed rate, which is typically good for a 1-year period, which is known as your initial rate. And then each year, this rate changes on your contract anniversary and becomes your renewal rate for your next 1-year period. Under the indexed rate choices, you'll find rates with terms such as cap rates, monthly averaging, spreads, participation rates, and triggers. These rates are not guaranteed and fluctuate. So under these scenarios, your credit with interest payments, if the index your returns are based on has a positive return year over year on your contract's anniversary date. No credit or loss occurs if the index returns are 0 or negative. Your contract's anniversary is the day of the year you initially purchased your annuity, so should this be December 12th, for example, then your returns are calculated and paid every year a few days after December 12th. It's important to understand how the index your investment is linked to works. There are often many choices, and it's helpful to know the mechanics of your index. You can choose to allocate your investment into either the fixed rate choice or the index side of the contract, or any combination the contract offers. Most crediting method, rate, or bucket decisions must be made within a few weeks of your contract anniversary date. If we look a little bit more closely at cap rates, monthly sum, spreads, participation rates, and triggers, cap rates are when your contract value can increase up to a certain amount, but not beyond. And no loss of principal can occur because the market declines over whatever time period you choose in return for caps or limits to any increases. For instance, a 1-year 5% cap rate means that your account can increase up to 5% in 1 year, but not more. A 2-year 8% cap rate means that your account can increase up to 8% over a 2-year period, but again, not more. 1 and 2-year annual cap rates are the most common, and typically the longer between measuring periods, the higher the cap rate can be. Monthly sums, also called monthly point-to-point or monthly averaging, with a monthly cap, take a difference between the beginning of the monthly value of the index used and applies a monthly cap. For instance, using a 2.5% monthly cap. If the first month of the contract, your index goes up 2.75%, your account gets a 2.5% credit. And if in the second month your contract goes up, the index goes up 2.1%, your account will get a 2.1% credit. So far, 2.5 and 2.1, you've earned 4.6. However, there's no limit to negative returns each month, and all 12 months returns are added together for your annual credit. So large negative monthly returns can quickly take away from any gains. But recall, your annual contract anniversary returns can never be less than zero. Spreads are when you earn the returns of an index with no cap, but with a deduction to the indice's returns, which is then referred to as the spread. Now, no loss of principal can occur because the market declines in whatever time period you choose. So for example, you might have a 1-year index with a 3% spread. So in these instances, you take the returns of your index less 3%. So if the index returns 4%, you'll earn 1. If the index returns 5%, you'll earn 2. If the index returns 11%, you'll earn 8, and so on. Now, more recently, spreads have been based on balanced indices versus all equity indexes, so that's something you might need to consider. A metric that's similar to spreads is something called a participation rate, where a spread is the deduction from a gross rate. A participation rate is a calculation of how much the index does times a participation rate. So for instance, if you have a 40% participation rate and the S&P increases 10%, you'd be credited with 4%. A 12% return would credit you 4.8. Just multiply the index return by the participation rate. And lastly, triggers. Triggers is when the index exceeds a certain level, you get a definitive return. For example, if the S&P returns more than 0%, you'll earn 3. So regardless if it returns 1, 5, or 19%, you'll get 3%. You might see a 5% trigger and a 5% rate. Typically, higher triggers have higher rates. However, higher triggers make it less likely that the returns necessary to earn any interest will be achieved. One generalization is that rates, caps, and spreads are more in your favor the longer the measuring period. So 2-year rates, caps, and spreads are better than 1 year, and 3-year better than 2. In addition, an index return excludes dividends. So your return from an indexed annuity will also exclude dividend income. This is important because history indicates that dividends have been a strong component of equity returns over the course of time. Further, riders are also available on some indexed annuities. With an immediate annuity, you invest a sum of money with an insurance company in return for immediate cash payments, as the name implies. Immediate annuities do not have any investment management fees or expenses, and any annual contract fees and/or optional rider fees are incurred via a lesser rate versus a hard dollar fee or deduction to your account. Immediate annuities are generally irrevocable decisions. With most immediate annuities, once you submit your premium to an insurance company, you are locked in to the payment plan selected. If your immediate annuity has a lump sum return of premium option, it most likely comes at the cost of a lower payment amount over the same period of time as an immediate annuity without the cash refund option. Your investment safety is based on the claims paying ability of the issuing insurance company, and immediate annuities provide you with cash payments that can last for any period of years. Typical periods are 5 years, 10 years, and lifetime payments. Some annuity companies can customize payments to whatever period you need, 7 years, 11 years, 18, etc., but 5, 10, and lifetime are the most common options. Immediate annuities are essentially annuities that are purchased and immediately annuitized. Riders are generally not available on these type of annuities. A variable annuity is a contract between you and an insurance company in which the company promises to make periodic payments to you starting immediately or at some time in the future. A variable annuity can provide you with investment growth and/or income. With variable annuities, there are annual operating expenses or fees for most of the base contracts offered that are called mortality and expense charges, or M&E for short. The mortality charges pay for the standard death benefit, which I'll describe in a moment, and the expense portion is intended to cover the cost of providing and administering your entire contract. Your investment choices in variable annuities are known as sub-accounts. These sub-accounts have investment management fees or expenses much like mutual funds. Additional riders, which I'll also describe in a moment, have fees, and lastly, there might be an annual account or contract fee of $50 or so if your account falls below a certain threshold. Some contracts may offer a return of premium guarantee through the purchase of a rider. Most variable annuities have surrender charges and a penalty-free withdrawal amount. Your investment is based upon the claims-paying ability of the issuing insurance company, and in a standard variable annuity, there are no guaranteed investment rates or interest to the contract owner. Although you'll typically have a return of premium death benefit as a standard benefit, meaning if the annuitant were to pass away, the beneficiaries would receive back at least what the total amount of original investments were, less withdrawals, regardless of whether the original investment was a lump sum or payments over a period of time. Variable annuities do offer annuitization as an option, and monies invested into a variable annuity can increase or decrease based upon the value of the performance of your investment choices, which we described earlier as sub-accounts. Variable annuity contracts usually offer a wide range of investment choices, ranging from conservative to moderate to aggressive. You can lose money in a variable annuity if the sub-accounts decline in value and you withdraw your investment in a lump sum without annuitizing or utilizing any riders. And most variable annuities do offer riders. A structured annuity is a variable annuity contract with an insurance company where your rate of return is based on an index that can increase or decrease over the term and have any decreases protected up to a set amount. Structured annuities can be used for investment growth and principal protection. Some contracts have fees and expenses, such as administrative fees, investment management fees, and other fees that can vary with performance, and some offer no fee options. Most structured annuities have surrender charges and a penalty-free withdrawal amount. Your investment safety is based upon the claims-paying ability of the issuing insurance company. Hey everyone, Chris again, and still here in the office doing some editing. Believe it or not, in the short amount of time you've been watching this video, we've been here in the office editing this for a few hours now. And the best way to explain the way a structured annuity works would be to revert back to a video I recorded a few years ago that's kind of a pretty good graphical representation of the participation rates, caps, and index choices. So let's take a look at that real quick. A structured annuity is a variable annuity contract with an insurance company where your rate of return is based on an index that can increase or decrease over the term and have any decrease protected up to a set amount. As an investor, you'll have three choices to make for your contract: index, term, and the protection level cap rate. Indices include, but are not limited to, major indices like the S&P 500, NASDAQ 100, Russell 2000, and MSCI EAFE. Terms are typically offered from 1 to 7 years and are measuring periods within the length of the contract, and each index and term will come with a few protection level cap rate choices. At the end of the term, the protection level will refund any account decrease up to the level of protection. A protection level of 10% means that the insurance company will refund up to 10% of any losses, and a protection level of 25% means that the insurance company will refund up to 25% of any losses. It is possible that the index losses exceed your protection level and your losses are not completely refunded. Cap rates are limits on returns that can be as low as 10% and as high as 200%, depending on the term and protection level. It is possible that the index gains during your term are greater than the cap rate, such that you do not receive all of the index gains. Typically, longer terms offer higher cap rates. However, cap rates are reduced as protection levels increase. The lower the protection level, the higher your potential cap rate can be, and the greater the protection level, the lower your potential cap rate can be. Standard structured annuities offer tax-deferred gains, and some offer a return of principal less withdrawals to your beneficiaries if you pass away. Some contracts have fees and expenses such as administrative fees, investment management fees, and other fees that can vary with performance, and some offer no-fee options. If you buy your annuity in an IRA, there can be an IRS penalty of 10% to make withdrawals prior to age 59 and a half. And all contracts have cancellation fees known as surrender charges. Understanding annuities and how they relate to your retirement planning can be helpful. If you haven't already taken time to download my guide, take a moment to do so now. Then if you think an annuity may be suitable for you, take the next step and ask for a customized quote. We're here to help. Thank you very much.